So I wanted to look at Form 8949, IRS 8949, which is to help in looking at the sale and disposition of capital assets, which for most people would be the sale of stock. Now, if you sell a stock, you have to categorize it as one of two things. Well, one of a few things actually. You want to see if it's a short-term or a long-term sale. Right now, Part 1 of the 8949 deals with short-term transactions, or basically things that you've held for more than a year. So if you bought this January 1st of the year, you would probably sell it January 2nd of year 2, just to be safe, adding the next day into it. Part 2 of this form deals with long-term transactions, or ones that you've held for more than a year. Now, the tax treatment of both of these I'll go into later, but in terms of looking at the actual form, let's say that you had traded Morgan Stanley and you bought it one day and you sold it the next. So let's say you had an E-Trade account and you bought like 100 shares. Now, if you bought this, let's say 1st of June for 2012 and you sold it the 1st of July, that would be considered a short-term transaction. So the sale proceeds, that's how much that you've actually sold it for. So if the stock was worth $1 and you bought 100 shares of it, what you essentially paid for it was $1,000. Now, let's say that it went up another dollar, so it's now worth $2 and you have 100 shares, so you have 200. Well, my math is awful. Then you have essentially a $100 gain, which is reported over here. Now, the key is to, again, figure out what the, if it's short-term or long-term, but something else that's you have to take into consideration is why is this over here, which is that short-term transactions reported where basis was not reported to the IRS when basis was reported, or if you didn't have it to 99B. The reasoning for this is, I believe there's a requirement now that says that each stock transaction that occurs, the IRS needs to be informed of the proceeds and the basis. Well, if you ask yourself why is this, it's because let's say I decided to be a little tricky and I say that I sold my shares, 100 shares of Morgan Stanley for $1, sorry, $2, but my original price wasn't $1. I actually paid $2 for it. So basically, I bought and sold it for nothing, in which case I'd have zero gain. Now, basically anyone could do that. You could pretty much say that your basis, or what you paid for it, is exactly equal to your proceeds, meaning that each time you bought something, you gained nothing. So if you sold it for $500, your basis was $500, you report zero gain. So the essential part of this is so that at the end of the day, and I hate using that phrase, but I'll try to stop doing it, what you report as a gain is pretty much predetermined because the basis has already been known. So when you send this to the IRS and they're looking at the proceeds, that can be matched to see if the gain that you report on your tax return is also the gain that they would be able to corroborate with their records. Not entirely too sure of the validity of that, but the general idea is that the basis needs to be reported, or for the most part it will be. There shouldn't be too many where it's not. But the reason that you have this over here is so that you don't just say, I paid the exact same price that I sold it for and I recognize no gain.